Two, one.
Hello, everybody. We're back. I'm Tom Sosnoff. This is Truth or Skepticism. It's just after 1 p.m. Central Time on October 25th. I'm here with Dylan Radigan. What's up, Mr. Radigan?
Big relief. Feeling a lot of relief. I had a lot of tension in my neck. I had a lot of sore muscles. I feel a big relief.
All right. Where this has got Batista written all over it.
New Speaker of the House. New Speaker of the House. Big relief.
Praise the Lord. Who? Can I ask what election denying conservative did we choose? I'm just curious.
We chose well, Pat. What you've won is the congressman from the 4th district of the state of Louisiana, a Christian, a husband, a dad, a constitutional attorney, and an election denier who voted.
I love constitutional.
He worked for Trump.
Oh, he worked for Trump. I love constitutional attorneys who work for Trump, and I'm great.
So anyway, all the more reason to inspire my activity on the Cenk Boebert Sanders Swift super PAC. Because with leadership like this, the world needs Cenk Boebert, Sanders, and Swift more than ever.
There you go. Throw Beyonce in there, because according to Vanetta, Beyonce and Taylor Swift have a better chance of the ticket than anybody. So we'll take those two.
Will Beyonce goes on the fundraising list?
Yeah.
What about Britney?
I don't know.
That's questionable, right? That's where you draw the line.
Britney Mahomes or Britney Spears?
Britney Spears.
Oh, well, sure. I think the craziest pair of them all would be Britney Mahomes and Britney Spears. That would be a fun one.
the Britney Squared super PAC?
Yeah, the Britney Squared. Exactly. We could have some fun with that one.
All right. Well, anyway, we have time to work out the super PAC. I was looking at the numbers coming across the screen because of they were put in front of me.
Okay.
And the one that stood out, at least superficially, was the percentage of new money flowing into managed money and the net negative outflows of managed money over the last, decade plus.
Okay, so I need some context.
Yeah.
Yeah, I'm not sure exactly.
All right, so I'll read it for you.
Okay, yeah, read it to me.
I'll read it to you.
Because this is a fascinating topic for me.
And me as well, and I have some land to cover here. So
I do too. I just want to make sure we're talking about the same thing.
All right. I'm just going to read you some facts.
Okay, good.
Much like my briefing from the House floor.
What's his name again? Mike Johnson?
Big Mike Johnson, they call him.
Mike Big Johnson. I like that. Big Mike Johnson. No, I like Mike Big Johnson.
Big Johnson. That's what Tony will call him. That's your new Speaker of the House, is Mike Big Johnson from Louisiana.
There you go.
He's going to say some things. He's going to do some things. He's going to have some things to say the next few weeks. You're going to have to listen.
Oh, sure.
All right. Anyway,
listen up, boys.
Not now. Right now we're on assets. 100 trillion. This is managed money, so mutual funds. This is some interpretation of passive, I guess. Although I suppose it's directed into like sector mutual funds. It's not all necessarily pure indexing, but managed.
Okay.
And they're estimating the value of that industry in terms of managed assets is plus or minus 100 trillion.
100 trillion.
Must be a typo.
No. Managed. Is this global?
Yeah.
It's possible.
Okay, that sounds very big. What's the global economy?
I didn't think it was that big. 100 trillion. 100. Hold on. 100. Let me just process this in my head for a second. 100 trillion sounds like too much. Managed assets, 100 trillion. Yeah. It sounds like a lot.
Sounds like the value of all the assets. But anyway.
What's the source of this?
This is from Bloomberg, from a Bloomberg column.
From a Bloomberg column. Okay, so let's assume they did their homework. All right, that's fine.
It's a quote from a Bloomberg View column.
Okay, that's fine. That's fine.
Published in the past day or two.
Yeah, okay.
$100 trillion industry, the relevant component, regardless of scale, is 90% of new revenue for managed money, so new revenue.
Okay.
Since 2006.
Okay.
That's 15 more. That's 17 years of revenue.
Yes, 18, almost 18. Got it.
90% of new revenue since 2006 is not from new money being invested or marginal cash inflows, but rather from asset price increase.
Okay.
Over 600 billion in client cash has left in that time, net.
Okay. That seems like a crazy small number.
Well, I feel like there's a BT issue here.
That's what I do too. If you're talking about if you're reading it directly from the article, if you're talking about 600 billion leaving from 100 trillion, that number is insignificant. It's 0.6%.
But I believe that that's a data issue on this quote from the article, not because that's what we're talking about.
Yeah, I think they're probably. I just guess that they're probably talking about 1 trillion, or no, it can't be 1 trillion because Schwab has no, because Schwab, Fidelity. No, it has to be 100 trillion because Schwab, Fidelity, State Street, BlackRock, and Vanguard together are somewhere in the neighborhood of 30 to 35 trillion. Just those.
Then the 100 makes sense.
Then the 100 makes sense because just those, I want to say I think the largest firm is BlackRock, and I want to say they're up around 7 trillion. And if you throw in State Street, Vanguard, Fidelity, Schwab, and I'm forgetting somebody, but they're if you throw in like the top 5 firms, I think they're very close to 25 to 30 trillion in customer assets.
But I think Matt's point in framing the data in this column is not so much the proportional movement, but the fact that the net direction is negative, not positive, that it's distributing money, that it's not accumulating money. And even when it is accumulating money, most of what's accumulating, 90% of it, is from retained assets.
Okay.
And Matt's suggestion is that the failure to attract more assets, new fresh cash, and the fact that the net trend marginally is a drawdown is evidence of the shift towards self-direction.
Yeah, that assumption is flat out wrong. And I will tell you why. Because if the $100 trillion number is even close to correct, which I'm assuming that it is globally, the 600 billion in assets withdrawn wouldn't even cover the tax on those gains.
But what about the 90% of the the revenue coming from existing asset appreciation?
That I totally believe. That makes total sense to me. So I'm saying you have to discount the 600, whether it's 600 billion or 6 billion, whatever the number is ultimately. That number to me seems incredibly small given the size. I mean, I know they thought that 600 billion sounds like a lot, but given the $100 trillion number, that number doesn't even cover taxes. So I don't think that number is relevant. But the 90% of the gains that are based...
90% of the revenue is from existing...
No, I'm sorry,
gains.
90% of the revenue from existing monies. That kind of makes sense. To me, at least.
Well,
can I tell you why it makes sense?
Yeah.
Okay, I'll tell you why it makes sense. Because in the world of finance, this is passive money, right? We're talking very passive money that doesn't move around. It's incredibly sticky. You are going to make about 90% of your revenue. Okay, if you are BlackRock and Vanguard and Fidelity and Schwab and everything else, you make about 90% of your revenue from 10% of your customer base. So this is not a testament to everybody, just staying in there. This is the top 10% of that entire customer base basically just letting their money grow because it's been growing and making the same or more money. Every money manager.
So 10% of the people or 10% of the assets.
Yeah, generate 90%.
Account for 90% of the revenue because it's such a big number.
But the same thing. Like if you went to Schwab right now and you look at and I'm just talking about Schwab because I happen to know their numbers. But if you went to Schwab or any other firm, Fidelity or E-Trade or any other firm, they make 85% of their revenue on 6% of their customers. Mm-hmm. So, Tasty's a little bit broader. We make 80% of our revenue on 20% of our customers. So those numbers of making 90% of your revenue on 10% of your customers is completely in line. And the RIA business is nothing different. We owned an RIA business from 2000 to when we sold Thinkorswim to 2000 to 2009. And we owned a small RIA business that we built in Bloomfield Hills, Michigan through a deal that we made. And so we had $350 million in revenue. And I would say, Dylan, we made 350 million in assets. And we made, I don't know what the revenue was, and that was a small amount of revenue, but we had 350 million in assets. We made 90% of our revenue on less than 10% of our customers, maybe 5% of our customers. So it's very much in line with industry statistics.
But the question is there anything in that fact, which because you describe it as a timeless universal principle, which surely it is.
Yeah.
But is there anything in that fact at this moment that's evidence of a sentiment shift generationally or culturally towards self-direction?
No, not at all.
Is there anything in the data from managed money that points to
no, I know the story they were trying to create. But I mean, I
You're
know
not buying it.
I'm not. None of it's true. But what I will say is, if you go back and you look at the growth of certain industries, and again, a lot of this has to do with the amount of money that's out there now versus the amount of notional volume that goes through trading pipes at Tasty and all these other firms, has grown 100-fold from 20 years ago. So the amount of active participation in the markets has grown dramatically, and you have seen different transformational moments in the last decade, especially 2021 in the meme stock explosion. You saw a transformational moment at Robinhood and other places, with all the meme stock, and you saw a transformational moment in Bitcoin and digital assets with a whole generation getting involved. So there have been transformational movements in the last 2 or 3 years and the last 5 years from passive to active. And I think there's been a steady flow. I mean, I'd like to think that Tasty's been at the forefront, on a certain level, percentage-wise, of leading that movement. But all that said, I don't believe that article or those statistics are relevant at all.
Why not?
For the reason I just said. I just think that's all.
That it's evidence of the structure of that industry, not anything else.
Exactly. That industry is incredibly sticky. And and people in that demographic that want to trade have a tendency not to kind of touch their nest egg, so to speak, even though some do, but there's a tendency not to. And most of the money that comes to us, it's new money. Like I can count probably on one hand the number of transfers from BlackRock to Tasty Trade, the number of transfers from State Street to Tasty Trade. It's not in the nature of this business. Our money is new money. The however many billions of dollars we have that is traded, at this firm, however many billions of dollars is traded at E-Trade or at Interactive Brokers or some other firm like that, whatever number of billions of dollars that all these firms have together, it's a drop in the bucket compared to what the trillions of dollars that everybody else has, and B, it's not part of it doesn't come from these old managed RIAs. It's all new money.
Which would then, I would argue that that's a new money that's not going to the old infrastructure.
You're right. It is. It is new money that's not going to the old infrastructure.
So you would basically say everything is true, but this data is not evidence of it. That's all.
Yeah, and there's certain economies, like if you look at, you go to India. I'll use India as an example because I think it's a really the culture there is, they've had massive growth in their capital base, and they've had massive growth in different industries, and so there's a lot more wealth than there's ever been. None of that money gets managed, the culture is we'll manage it ourselves, and the culture in China is we'll manage it ourselves, and all that massive wealth, in different places doesn't get managed like it traditionally gets managed in the U.S. So the amount of global growth that has gone into kind of self-directed pools of money, liquidity pools, is very different today than it was 20, 30 years ago, and most of that new money goes, people mix it up a lot. They're a lot smarter about it. They'll do some private equity. They'll do some self-directed. They'll do some, traditionally have somebody manage their cash or something. Who knows? But it's just a very different world than it was 20, 30 years ago. So all that growth sounds normal, but I don't think it's not some systemic thing where
there's no inflection. There's no meaningful insight other than basically as people get older, it'll happen over 30 years, 20 years as people die.
Yeah. Listen, look, my kids are not running to Goldman Sachs and saying, as they begin to acquire wealth, and they're both in their early 30s, they're not running to Goldman Sachs or somebody else, Fidelity or Vanguard, and going, hey, how do I buy a mutual fund? When I was in my 20s, it was like, oh, you got to buy this fund at Vanguard. It's great. Or you got to buy, whatever. And it used to drive me crazy because I was never doing that. But I was in the minority, that the majority was doing stuff like that. My parents were the same way. What are you doing? Just go buy a mutual fund. I got the Value Line book right here. Pick one. My kids are like, okay, what should we buy? What do you want to do?
Do you think that the self-directed experience? I mean, obviously, the self-directed experience has improved over the last 10 years a lot.
Of course,
right?
the technology is amazing. Yeah. The content's amazing.
How much better? I'm trying to think about an insightful way to ask this question. I guess
1,000 times better.
Yeah, but to what end, right? Because ultimately better means more self-directed investors having a more coherent relationship with risk and the best probability of a profitable outcome, or at least an understanding of that, so that if they don't do it, they know why it didn't work.
There's less give up to theoretical, and there's much more efficiency. It doesn't mean you have necessarily a better chance of success, because efficiency is not. There's no correlation between efficiency and success, but what there is a correlation between efficient opportunity and success. And in today's world, you can really go anywhere instantaneously to any marketplace, and that's cool. It doesn't mean it's not going to increase the percentages that dramatically, but it does provide opportunities that never existed before without negative edge, without any theoretical, without any give up to theoretical.
But beyond that, there's also the sort of the filter that you've invested in, which comes down to pot odds on some level, right? Risk awareness,
the opportunity to take advantage of pot odds, which never existed before. If I thought the Japanese yen was cheap 30 years ago, I had no way to play it. I mean, other than buying a Japanese yen future, maybe, I had no way to play it, but I would have to pay $60 to buy that future. Now you buy that future for $1.25, and I can trade the options electronically and the future electronically, and I don't have to call somebody. I know my fill instantly. It's a different world. The technology today, the content today, the access to marketplaces, the indifference to product, everything's been commoditized. It's amazing.
Do you think that self-directed traders that adhere more closely to pot odds do better? which almost is like a rhetorical question, theoretically, mathematically.
I think that I can't answer that because I don't know the answer. I don't know the answer, but I would think that poker players that adhere to pot odds probably do better. I think that traders who adhere to pot odds probably do better. I mean, that's what I believe, but I don't have any evidence to prove that.
Mm-hmm. And then you would have to mix in with sizing, I guess. And more important than sizing or pot odds would be the migration of the awareness of the customer, as evidenced by the full houses when you tour around the world.
Yeah, but it's more of a nuanced know-how. I like to use the term nuanced know-how because the world of self-directed finance is all about nuanced know-how. I mean, it's not complicated, but there are little things that it's like anything else. It's like, sports and sports betting and fantasy football, everything like that. It's all nuanced know-how as well. It's the same thing here.
In terms of having basically to have a feel.
Yeah.
Which is what sports requires.
The whole difference is marketplace efficiency. The entire difference is efficiency.
Mm-hmm. And yeah, it's an unanswerable question.
Yeah.
Because basically you just have two pillars. You have you're basically in a technical transition.
Yeah.
And ultimately no one knows the answer to any of it other than, I guess, the rate of change will be the only thing people are trying to infer, like Matt, in your opinion, failed to infer, but he was trying to infer that there's a shift in momentum in favor of self-directed. But probably that sort of a mapping would probably be best derived from like a demographic chart as the baby boomers and Gen X die.
Yeah, there's certain things you can control, and there's certain things you can't. Like if you were a self-directed bond trader for the last, 5 years or whatever it is, you basically lost everything because you were trying to play a catch-up game in a world where the passive marketplace, basically the principle imploded, and so there's nothing you can do. The underlying just won, and so I think the challenge is that the thing that I like to talk about is control of the things you can control, and which gives you at least the flexibility and opportunity to make it through times when the things you can't control don't work in your favor. Like if you're a person that plays positive drift, that's wonderful, as long as there's positive drift. If there's negative drift for 5 years and the market loses, 30% of its value, you're going to lose 60% or whatever. You're going to lose at least 30 plus. Mm-hmm. And at least having the ability to do something about that, to me, is far more fascinating rather than being at the mercy of positive drift.
Right. That in other words, it's the value of engagement versus non-engagement, which is that's the age-old philosophical discussion, right?
Yes, exactly.
And the issue is that the advocates of both have some degree of self-interest.
Yeah.
For obvious reasons.
Yeah, sure.
So it becomes, and at the end of the day, it's about your relation. The thing is, because money becomes, this is a totally different conversation, but money becomes a function of a relationship with the world and sort of a sense of security and opportunity and freedom and all those things, which then are affected by, the reason your parents wanted you to buy a mutual fund is because they thought you'd be safer. So they would feel less anxious if their son had his money someplace that they thought was safe.
It's all they knew. It's the only choice.
Yeah.
Yeah. It's plus it was the only choice.
But also there's a perception that self-direction may have more opportunity, but it has more risk, that it's more unsafe. That's a perception that's promoted from the incumbency for sure.
Okay, fair.
But your point is it's irrelevant because it's a generational shift. It's not a marketing battle. It's a generational transition.
And sure, everybody's got different self-interests and motivations, self-motivations and everything else, but it's a business like anything else. Sure.
All right. Enough about all of this. Shall we move onward?
Yeah, let's move onward.
Okay. I got a few things on my list, most notably the dollar extremity and 1,000 ways to make money on the other side of the dollar.
Okay, let's talk about it. I think it is one of the most extreme markets right now. I think the U.S. dollar is, I don't know how else. I'm going to just pull up my own just to take a look at the whole dollar stream here, but I don't think there's any other way to discuss it. I mean, the U.S. dollar, this is not the craziest move up or down that we've ever seen, but it's among the greatest moves. The U.S. dollar is incredibly frothy.
And so, on the one hand, it doesn't matter what you do, as long as it's liquid, right?
Exactly.
I know what you
exactly.
With that said, as a practical matter, what liquid instruments have you been using?
I've been using the euro and the Japanese yen, but because the euro and Japanese yen do not have that tight a correlation, so I have positions on both of those. And so far, the Japanese yen has definitely not worked, and the euro's been, my euro position came on later, so the euro position has been fine. But yeah, that's it for me right now. I mean, I will put on more, but that's all I got right now.
And then is there anything, the only other thing that seemed to have some extreme aspects was the bond market.
The bond market is at an extreme, and that has not changed. I don't put the bond market in the same, I don't put the reasons for the bond market doing what it's doing in the same bucket as the US dollar. I do think that they're very different. And I'm not going to get real fundamental about this. I just don't consider them, that highly correlated over time. I know there's been an inverse relationship as of late, but I don't consider that to be something that's necessarily sustainable. I think they're two very independent trades. They're both pot odds trades. So that's the interesting piece about the US dollar. The one thing about the US dollar and bonds, which a lot of individual investors don't realize, like if you went to the man on the street and you said, hey, how do you trade the US dollar? Nobody would know. Tasty traders would know, but the average person has no idea. And currency is something that the rest of the world really understands, whether you're in Argentina right now, or you're in Russia, or you're China, wherever you are, Japan, you understand, currencies and value of your dollar, fiat currencies, everything like that. But I don't think that I don't think anybody in the U.S. really knows how to trade currencies.
Yeah, I think that's always true.
Yeah,
I mean, but I think that's also a function of just the reserve currency, right? There's a indifference to policy. Sure. There's been no policy risk to the U.S. dollar for anybody's lifetime.
We're ethnocentric. We have no. Most people in the U.S. don't even know that there's other currencies. They don't. They just don't know. And if they had to trade it, they would have no idea. But they don't realize that if you're looking at just like the euro, for example, and you wanted to put a position on, and you wanted to bet on the U.S. dollar against the euro, they don't know you could just go out and sell 104 puts and collect a lot of money. Nobody knows that. Nobody knows what you can do. Nobody knows how to trade. Nobody knows how to trade bonds or the U.S. dollar.
Do you think the first and easiest way to do that is through options on futures or options on ETFs?
Yeah, of course.
Of course. That's the front door to the house.
Sure, because the futures themselves and the cash markets are very black and white, and they're very dangerous and expensive on a relative basis. The options have much less volatility, and they're only a fraction of the futures. If you sell an out of the money put that has a 30 delta, it's the equivalent of 30% of the future. That's it. And so that's a 70% reduction in risk, pure theoretical, and it's a high probability of profit. It's a 70% probability of profit. So I don't think people understand that doesn't mean we're not talking about anything crazy. We're just saying, hey, if you think something has good pot odds and you want a 70% probability of profit, you can play it. That opportunity exists for everybody. And in the bonds, it's the same thing. I mean, like I look at the bonds at 108.5 right now and think of them as, oh my God, these things have unbelievable upside pot odds. I look at the euro and say, this has unbelievable downside pot odds. I'm sorry, the euro has upside pot odds. The dollar has downside. But I look at those two things and I think the pot odds are good. I think you're risking one to make two. I like that. Or you're risking one to make one, but you have like an 80% or 75% probability profit. I like those. Like to me, that's what opportunity is all about.
And how much of that is a result of technology, and how much of that is a result of feel? How much of that is because of what you get consumed through your dashboard on your monitors, and how much of that is because you've been doing this every day for decades, or anybody does it all the time?
First of all, 100% of the assumption, the subjective assumption that there's decent pot odds there, 100% of that is feel. There is no, I don't know.
There's no dashboard that's going to get you there.
No, there's no chance. I could be off by a factor of 3. Who knows? I mean, the downside could be 3 times the upside for all I know. So that's just my own individual, I'm just me talking out my butt type thing.
Right.
But the math part of it is 100% spot on. That's indisputable. The pot odds piece is totally subjective. The math piece, the probabilistic side, is fact. It's indisputable.
But it's also, but the math tends to validate your hunch insofar as the numbers are 3 to 1 or whatever they are, as opposed to 10 to 1, or however the ratio moves around to your benefit, can either be validating or invalidating to your hypothesis, I suppose.
Kind of, yeah. I'll let you have that, counselor.
You will.
Yes. Anyway,
you just don't want to.
I just see one of the missions of Tasty was to basically tell the world that, hey, you know what? You listen to, okay, I'll take a young Dylan Ratigan on Bloomberg, 25 years ago, whatever it was, and you're sitting there and you're telling people, and you're talking about the bond market, all right? And people are like, oh, that's interesting. That's it. That's all you can say is that's interesting.
But no, you could also say mortgages are going to be more, mortgages are going to be less.
Big deal. What is that going to do? What if you already have a mortgage on your house?
You could say startup funding is going to be more or less costing. But you could hypothesize.
Hypothesize. Who the hell cares about hypothesizing? You can't. There's nothing you can do. Like if you said to me, the Bears are playing their backup quarterback, Tyson Bagent is playing on Sunday. He's starting Sunday night. The Bears are 8.5-point underdogs. If I'm willing to give up a massive amount of vig, I can bet on that game, and I can take the 8.5 points on the Bears and bet on my underdog quarterback. But at least the opportunity is there to do it, so I know that 8.5-point line is real. In the option world, since everything's a tick wide, sure, you can bet on anything. So I know everything's real. All I don't know is if the pot odds are really what I think they are.
But you know what the market thinks the pot odds are?
No, I don't. The market doesn't know pot odds. The market only knows theoreticals. The market doesn't know pot odds.
Fair enough.
Yeah, the market doesn't know any pot odds. The market doesn't know anything. The market doesn't know anything that's random. The market only knows what the variables plug in to spit out. That's it.
Are the people different? Do you think that the decisions self-directed traders make when they're not self-directed trading are different people than people who aren't self-directed traders?
No, everybody's the same.
No, but I'm saying when somebody adopts the mindset of a self-directed trader, do you think it affects the mindset for other parts of their lives?
Of course it does. I talk about it all the time. What do you mean how? Changes everything about their lives.
Everything. That's the point. Right?
Everything.
So they are different.
I mean, they become different.
Yeah, they become transformed through the new mindset.
I'd like to think that.
And then does that new mindset then create new creativity that creates a new way of
I'd like to think that.
Doing business?
I'd like to think that. That's
or living even.
That's what I believe.
And do you know what that looks like?
No, but we have considered lots of different ways of testing it. We haven't been able to. I cut a couple of deals with some neuroscientists over the last couple of years, but none of them ever came to fruition because I wanted to actually prove, although this was extremely hard to do, and we tried to do it, but we weren't able to find the right number of people, use cases, and all this other stuff. But I wanted to prove that the speed of decision making is something that can be is something that's learned,
can be changed. It can be influenced through behavior and training.
It can be accelerated. You can go from 1x to 100x. I believe it. And my argument is going to be the people that go from 1x to 100x are, significantly better in business, in every aspect of life, but specifically business. And I, unfortunately, it was really hard to do. We hired one firm, but they weren't ready for the neurological tests. We hired another firm, but it required like 4 hours of time from each person. We just couldn't pull it off. It was too much.
Mm-hmm.
But
you're interested. But you believe it's true. You believe that the mindset changes the neurons.
I believe that that there's very little that separates. If you're talking about, like, for example, if you're talking about professional athletes, I believe that there is very little physically that separates most athletes, and the difference between somebody that's going to the Hall of Fame and somebody that doesn't make it is very much in their head, and it's in their ability to process things. Like, there's a reason that Tom Brady could play quarterback until he's 45 years old, because he was able to process things that just faster than anybody else. That's why he got rid of the ball so fast. That's why you could see the whole field in 1 or 2 seconds. He was able to process things. That's why somebody with a much better arm, like years ago, like a Jeff George or something, failed at every stop he went to, even though he had one of the greatest arms ever, because he couldn't process anything. His mind didn't work that fast. And I think that in the world of trading, it's the exact same thing. The greatest traders in the world and the greatest financial minds in the world are not people that are able to break down some giant macro picture of what's about to happen, this or that, or all that kind of stuff. I think the greatest minds in finance are the ones that are the fastest. Like I'll give you an example. There's this guy years ago, I'm not going to say his name, but he's a friend of mine, and I still friends with him till today. And he was the fastest person ever in the trading pits, ever. He could go in a pit with no markets at all, first day of trading on a new stock, and make the markets for every single underlying. And we would all just sit there in amazement. Okay, we just all would just sit there like, how did he do that? Like, his brain worked differently. He was so much faster than everybody else, and he is able to process everything and basically create a marketplace for every single option. And nobody else in the world could do that. And it was just all, no computers, nothing. And later on in life, he turned that into becoming a multi-billionaire by starting all these other businesses because his brain speed was so fast. That is something that, to me, is a fact. We have some partners.
But is that brain speed innate, or is that brain speed learnable? Maybe not to that extreme.
I don't know if it's that extreme. I mean, we have some partners in Chicago that a small group that we work with they've started $5 billion businesses. There's 2 guys, $5 billion businesses in less than 20 years. I mean, Elon Musk has done. He's the only other person I've ever seen. He's done what, $5 or $7 billion business. His are like 7, 8, 10 billion, whatever they are. As much as you love or hate the guy, nobody else has ever done that. Nobody in the world's ever done anything close to that. I mean, these guys in Chicago, they know that they've done it 5 times, and they're just like, $1+ billion business, or we've done it twice. It's really freaking hard to do, and it is. And all of our success, I tie back to standing in the pits, just trading our asses off, because it makes your brain go faster. And I think for these guys, I don't know where they picked it up, but they make decisions in 2 seconds. Yes, I'm in. 1 second, 2 seconds. That's it. I'm in. And I love that.
And how much of that is learnable through self-directed trading, in your opinion? Going back to your neurological...
I don't know how else you can learn it for most people. There's certain people that can find ways to make a lot of decisions, but I would say for 99.9% of the people, the only way I know how to do it would be... The only 2 ways you could do it would be either gambling or trading. And gambling has too much negative edge, so you will 100% go out of business. Trading has no negative edge. Everything's fair. Mm-hmm. So
maybe there's a biological component, like your buddy on the floor was making markets out of a ghost. And then there's also a learned component, the Kobe Bryant extra 4 hours in the morning.
Well, I mean, the Kobe Bryant's a perfect example. You know, I mean, there's certain people like Kobe and Michael Jordan that had this extraordinary physical skills that, you know, they have what they have. But Brady is a perfect example of somebody that didn't have the physical skills, just this crazy mind. I mean, there's lots of quarterbacks. One of the reasons that a lot of these quarterbacks are not as physically gifted, but they last forever is because it's just because their brains work differently. They process things differently. You know, that's all it is. They just can see things faster than anybody else.
No, I get it. I'm pausing because I'm just reflecting on the learnability.
Yeah, I think there is a certain piece of it that is very learnable. I just don't think, you know, that's just. I do think I don't think this is something you're necessarily born with. I think much of it is learned. And that's also why on the trading floors, you would get some PhD who's standing next to a high school dropout, and there is no edge to the PhD.
Mm-hmm. No, that's, I know. And yeah. It'd be interesting if you had the neurological research. There was a group, the story for a different time, because I know we're out of time, but there was a group of bankers in London that one time did a big neurological study having to do with management at the banks in London. They had different metrics, whatever, but they did the same idea, which is like, well, let's influence the brain formation.
Yeah.
And that's a.
We were this close to pulling off a deal to start to test that kind of stuff, and we just couldn't get over the finish line. I was working on it for months. I couldn't get over the finish line, and you know, sometimes that happens. You know,
But it's still a fascinating insight, just in terms of human beings.
Yeah, they were close, but they weren't at the point where they could get us to a statistically significant conclusion. And therefore, that's where we had to drop it.
Could say something.
Yeah. All right. Well, this has been great. I'm Tom Sosnoff. He is Dylan Radigan. We do this every Wednesday, Truth or Skepticism at 1 p.m. Central Time. Thank you for joining us today. And Dylan, thanks so much.
See you next week.
Yes, we'll see you next week. Thanks.
Bye.
Bye.